Retirement is not a distant dream. It's a stage of life all of us will face if we are lucky to live long enough. The big question is, how much money do you really need before you stop working for a living? This is Quick Take, your quick guide. I'm Smita Prakash. The time factor. If you plan to retire by 60, your retirement may last 20 to 30 years. That's as long as your entire working career. The challenge is simple. Your money has to work harder than you. But there's a problem. In India, costs don't stay still. Food, electricity, healthcare, travel, prices rise every year. At just 6% inflation, your expenses double in 12 years. At 8%, they double in 9 years. Inflation is the silent killer of retirement savings. The 70 to 80% rule. Financial planners suggest you'll need about 70 to 80% of your current income in retirement. If you spend 1 lakh a month today, you may need 70 to 80,000 in today's value. But 20 years later, that same 80,000 will feel like 1.6 lakh rupees. If you plan to retire early, say at 50 or even 45, you'll need an even bigger cushion because your retirement could stretch for 35 to 40 years. Of course, here you have to take into account whether you have paid off all your debts and loans on your home, vehicle, etc. The 3 layers of retirement planning. Layer 1, daily living, housing, groceries, utilities, transport and leisure. These are predictable, but inflation will push them up steadily. Start listing now how much you spend on these. Layer 2, healthcare. This is where retirees get caught off guard. Medical inflation in India is 10 to 12% per year, almost double general inflation. Insurance premiums rise as you age, and a single hospitalization can cost 5 to 10 lakh rupees, sometimes more. Without good health insurance, savings can vanish overnight. Layer 3, emergency fund. Experts recommend keeping 1 to 2 years of expenses in safe, liquid funds, which means fixed deposits, liquid mutual funds, or even cash equivalents. This ensures you won't be forced to sell long-term investments at the wrong time, like during a market crash. Examples. Let's put numbers to this. Case 1. You're 50 today, planning to retire at 60. Your family spends 10 lakh rupees a year. In 10 years, that becomes 18 lakh rupees. Over 25 years of retirement, you'll need 3 to 4 crore rupees. Case 2. You want to retire at 40. With higher expenses stretched over 40 years, you may need 7 to 12 crore rupees, depending on lifestyle, of course. Early retirement requires aggressive investing and iron discipline. A major factor is whether you are responsible for a spouse or sibling at the time of retirement. Where will the money come from? Most Indians today rely on a mix of EPF, NPS, pensions. These form the backbone for salaried employees. Real estate. Rental income is popular, but returns may not beat inflation. Mutual funds and equity. SIPs are the most powerful wealth building tool if you start early. Gold and fixed deposits. Good for diversification and safety, but not enough by themselves. The key is balance your portfolio. That must grow faster than inflation while you're protecting from big risks. Common mistakes to avoid: starting late. Compounding is your best friend, but only if you give it time. Ignoring inflation. Your money's future value is what matters, not today's. No health insurance. One medical event can derail everything. Relying only on property. Real estate isn't always liquid, and rents rarely grow faster than inflation. The takeaway: start early if you can, but even if you're late, don't panic. Break your plan into layers. Account for inflation. Keep an emergency fund. Secure health insurance and invest consistently. Retirement is not just about surviving, It's about living with dignity, freedom, and the ability to enjoy the years you worked so hard for. Your future self will thank you for the planning you do today.